Good morning and welcome to the American Enterprise Institute and today's policy forum on the narrow bank. Narrow banking is a concept that has long been advocated by economists as a way to avoid both the monetary instability that plagues fractional reserve banking and the evils of moral hazard created by deposit insurance and other government bank safety nets. As early as 1823 in England, David Ricardo drafted a plan for the establishment of a national bank in which he argued that money creation should be separated from lending by requiring banks to hold 100% in gold reserves. Across the pond in the U.S., the National Currency and Banking Acts of 1863 and 1864 required national banks to back their banknotes 100% with U.S. Treasury securities. Narrow banks take in customer deposits and invest the entire proceeds in super safe, interest-bearing liquid assets like government T-bills, or today, reserves held in a master account at a Federal Reserve Bank. Narrow banks bank customer deposits 100% with highly liquid safe assets, so there is never a question that these banks can meet depositor withdrawals without government assistance. Narrow banks do not need deposit insurance or emergency central bank liquidity to maintain depositors' confidence because narrow banks are ready and able to meet their depositors' redemption demands, even in a bank run, so depositors never see a need to run a narrow bank. If there is a downside to narrow banking, it is that narrow banking deposits cannot be used to fund loans because loans are risky and illiquid assets. If a narrow bank makes a loan, it does so using a bank's equity capital as the source of bank funding. Narrow banks are good at creating a stable and dependable money supply, but a narrow bank money supply is also rigid and unable to expand easily by making new business and consumer loans as the economy grows. If every bank was a narrow bank, the Fed would not have to worry very much about the stability of the banking system, but it would be hampered in its ability to use traditional monetary policy tools to influence the growth rate of the economy. Even after the creation of the Federal Reserve, narrow banks remained a favored passion among some economists like Frank Knight and his colleagues who pushed the so-called Chicago Plan and narrow banks as the solution for the Depression-era banking crisis. Narrow banks, while rare by the 1930s, were more than an intellectual fad among stability-crazed economists. In Chicago, there was a conservative family-run bank that rebelled against the Roosevelt administration's imposition of federal deposit insurance as the solution for restoring investor confidence in the banking system. John Milton Nichols, president of the First National Bank of Englewood, Illinois, abhorred federal deposit insurance, and his bank held almost exclusively cash and U.S. government securities. Nichols gained notoriety for his passion for the narrow bank solution, and it earned him the nickname 100% Nichols. Even in the depths of the Great Depression, his bank attracted deposits and made a profit, while many banks in the Chicago area lost deposits and many failed. As you can see, TNB's application to open and run a narrow bank is not in any way unprecedented in U.S. banking history. Indeed, the nation's national banks were all initially required by federal law to operate as narrow banks. What is perhaps new and different about TNB's application is that its business plan is to arbitrage a government subsidy that has, since 2008, been provided by the Federal Reserve, but exclusively to banks. In 2008, the Fed began paying interest on bank reserves in order to keep the federal funds rate, its primary monetary policy target rate, away from falling to zero. The vigorish in TNB's business plan comes from the subsidy the Fed provides banks through the interest it pays on master account balances. You see, although the Fed has repeatedly denied it, the rate the Fed pays on bank reserve balances, the so-called IOER rate, has been set rich relative to the fair market risk-adjusted yields available to non-bank market participants. This has been true since the Fed began paying interest in 2008, and it continues to be true today. Indeed, if the IOER rate does not provide an above-average risk-adjusted return, TNB will be unable to attract any depositors, and it will be forced to close its doors soon after it opens, that is, if the Fed ever allows it to open. In my view, the underlying policy problem the Fed faces when considering TNB's application for a master account is not that TNB is a risky bank. Indeed, if TNB follows its legal business plan, it would be the safest bank on the planet. The risk to the Fed is that TNB will unlock the bank's monopoly on the Fed's IOER subsidy. The Fed's strategy towards TNB appears to be avoid taking any public stance on TNB's application and quietly run out the clock on TNB's preliminary approval to run a narrow bank under Connecticut law. If TNB opens and it passes the Fed's IOER subsidy on to non-bank savers through mutual funds, eventually banks will face pressure to raise their deposit rates or risk losing deposits to money funds when the risk-return balance becomes more attractive once MMFs can harvest the Fed's IOER subsidy using TNB. So if you find it difficult to believe that the good folks at the Federal Reserve would stifle competition to protect bank profits, let me remind you that back in the early 1930s, New dealers thought banks' ills stemmed in part from ruinous competition among banks. To protect banks from instability created by ruinous competition, the Banking Act of 1933 prohibited banks from paying interest on demand deposits, and it capped the interest rates banks could pay on other accounts. These interest rate caps were administered by the Federal Reserve under Regulation Q. For many years thereafter, protected by deposit insurance and government interest rate caps, bankers led a profitable and quiescent life, a fact celebrated by the famous 3-6-3 rule of banking. Pay depositors 3%, lend them out at 6%, and be on the golf course at 3%. If TNB opens, operates, and makes a profit, in my opinion, there can be little remaining doubt that the Fed is subsidizing banks by paying them too rich a rate on their reserves. It's not a big leap to think that political pressure might try to hold the Fed accountable for reducing IOER bank subsidies, which would force the Fed to reform its post-crisis monetary operating policies. Are there substantial policy concerns behind the Fed's reluctance to approve TNB's application for a master account, or is the Fed just reluctant to face the political ramifications that may arise if TNB is successful? For the answers to these and other interesting questions, we are happy to welcome today Dr. James McAndrews, President and CEO of TNB, and following him, a panel of banking experts. But first to speak today will be Dr. McAndrews. Dr. James McAndrews is the CEO and Chairman of the Board of TNB USA, a Connecticut chartered bank. Previously, he was Executive Vice President and Head of the Research and Statistics Group at the Federal Reserve Bank of New York for a number of years. While at the New York Fed, Dr. McAndrews was a member of the steering committee for the Federal Reserve's Comprehensive Liquidity Analysis and Review Program and an associate economist to the Federal Open Market Committee. Dr. Andrews is widely published in academic journals and well-respected publications. His research focuses on monetary policy implementation, the liquidity of banks and markets, and monetary arrangements in U.S. history. Dr. McAndrews earned his doctorate degree in economics from the University of Iowa. Please welcome me in welcoming Jamie McAndrews. Thanks.
Thank you very much, Paul. It's great to be here at the Enterprise Institute. Thank you for coming. And I thank you very much, Paul, for organizing such a great program. I look forward to the comments of the other presenters. And today I'd like to talk about narrow banking in the current context, as Paul laid the groundwork very well, when the Federal Reserve pays interest on reserves. The key points are that narrow banking can deliver both safety and competition to the market for large deposits. The facts are that deposit markets of banking are not best described as perfect competition. Of course, there's FDIC deposit insurance, as Paul reviewed, and there are a lot of well-known costs in the finance literature of deposit insurance, primarily the moral hazard that Paul spoke of and the need for extensive supervision and regulation. Larger depositors, though, are both rate sensitive and very flighty. And the interaction between them and the private sector creates a significant financial stability risk. Narrow banks offer an important way to address both of these questions, the lack of competition and the flighty concerns about financial stability. First, though, I'd like to give a little bit of a primer on interest on reserves. Paul laid the groundwork well, of course. Between 1999 and 2006, various governors of the Federal Reserve System, Meyer, Ferguson, Olson, testified numerous times to Congress in favor of the payment of interest on reserves. You can see some of their comments there. The board strongly supports proposals to allow payment of interest on demand deposits on the required and excess reserve balances that depository institutions maintain at Federal Reserve banks. These legislative proposals are important for economic efficiency. Unnecessary restrictions on the payment of interest on reserve balances distort market prices and lead to economically wasteful efforts to circumvent them. This is a very important concept. Interest on reserves removes an inefficiency from the economy, the so-called reserve tax. Prior to the ability to pay interest on reserves, banks were required to hold reserves and were not offered any earnings on these reserves. Consequently, they engaged in costly efforts, which were all wasteful, to minimize their reserve holdings, which was a second problem. Because, of course, society would like banks to hold reserves, the liquid asset, which are necessary to meet withdrawal demands. So it was a very important achievement to allow the Fed to pay interest on reserves and remove this reserve tax and improve banking efficiency significantly. Importantly, in their testimony, the governors foresaw payment of interest being passed through to depositors. Coincident with their wish to pay interest on reserves by the Fed, they also testified to get rid of the last vestige of Regulation Q, which Paul was talking about, the prohibition on payment of interest by commercial banks to corporations. That prohibition was finally ended in the Dodd-Frank Act. And the governors all pointed out that banks would be able to pay interest on corporate accounts by virtue of earning interest from the Federal Reserve. They saw a direct pass-through to corporate customers. However, banks don't pass on this interest on reserves to their depositors. We see this in the diagram before you, shows the top line is the rate of interest paid on reserves by the Federal Reserve banks to banks. And the bottom lines are various measures of retail deposit rates. The top line is the jumbo, the top line is the jumbo 6-month CD rate, and the bottom two lines are the jumbo checking account rate and the jumbo savings account rate. These are deposits in excess of $100,000. So these are the largest depositors in banks. Now, it's one thing that depositors didn't earn anything for several years while the rate of interest was essentially zero at the effective lower bound. But since then, the rate of interest has moved up to 2.25%. The rate of payment on interest on reserves, 2.2%. And still, the jumbo savings and checking account rate are something like 10 basis points. In February this year, Jeb Hensarling asked Chairman Powell, so you're paying our banks 150 basis points, and they're paying my constituents 10 basis points. Is that correct? And Chairman Powell answered to the effect that, well, banks raise their deposit rates with a lag. I'll say that's a tremendous lag, and the spread has gotten only wider since February. Another measure of this lack of competition is the percentage of banks that don't pay any interest at all on their checking accounts. And this has stayed high even during this period where the interest on reserves has been moving up. Perhaps even more worryingly is the fact that large depositors also don't get interest passed through to them. This diagram looks at the period between 2009 and 2013. 2009 was after the storm had passed, the crisis was over, and 2013, I stopped there because after that the Federal Reserve introduced a new facility, which I'll describe in a moment. The top line is the rate of interest on reserves, and the bottom line is the effective federal funds rate. So you can see that during this period, the Federal Reserve was paying interest on reserves in order to act as a magnet so that banks would borrow funds at any rate below the interest on reserves and thereby move the market rates up to equal the interest on reserves. But you can see that it was a very poor magnet. The rate of interest in the market was not closely related to the rate of interest on excess reserves. Now, why is that? Well, there are a plethora of theories for why large depositors, why the market for large deposits is not perfectly competitive. For retail deposits, there's a very large literature that retail depositors' switching costs inhibit effective competition between banks. People have various direct deposits and bill payments associated with their demand deposit account. It's hard to switch to a different bank. But for large depositors, it's other issues. I have a paper with Rod Garrett and Ed Nozel that suggests that counterparty credit risks result in lender-determined risk limits that confer market power on banks. Other economists, including Darrell Duffy, who's on the board of TNB, and Arvind Krishnamurthy, suggest that segmented markets and search and monitoring costs all inhibit competition in this market and result in this lack of competition. In any case, it presents a terrible dilemma for the Fed. How is the Fed going to raise rates? In 2012, 2013, the Fed could foresee the economy was gaining strength and that they would soon have to raise rates. But we saw in the last slide that if they just raised the interest on reserves, there was no guarantee whatsoever that market rates would follow. So what did the Fed do? The Fed created a narrow bank. It's called the Overnight Reverse Repurchase Agreement Facility, the ONRRP. And they expanded an existing one called the Foreign Repo Pool. Simon Potter, who is the System Open Market Account Manager at the Federal Reserve Bank of New York, said on April 5th, 2017, when we were at the zero lower bound, we weren't able to rule out the possibility that initial increases in the policy target might not translate one for increases in money market rates. ONRRP, which is offered to a broad selection of counterparties that includes money market funds, is intended to intensify competition in markets. So the federal government went into business against the existing banks to provide bank customers, money market mutual funds and federal home loan banks, a narrow banking facility. Lori Logan, who's a deputy manager at the Federal Reserve Bank of New York, May 4th, 2018, said market forces keep the federal funds rate in the FOMC's target range by allowing a wide range of counterparties to price trades against the alternative option of investing with the Federal Reserve. And Simon Potter also pointed out, as a longstanding service to foreign central banks, foreign governments, international official accounts, the New York Fed runs an overnight investment facility known as the Foreign Repo Pool. Use of the pool has grown to about $247 billion. The ONRP at its height was in excess of $400 billion. So these two facilities together were above $600 billion. These are not small, narrow banks. These are big, narrow banks in competition, the federal government in competition with the private sector. They're essentially like the public option, which we heard about in the analysis and discussion of the Affordable Care Act. Many analysts suggested in the discussion on the Affordable Care Act that in counties or regions in which there was only a single insurer, or perhaps not even an insurer, that there should be a public option available to customers to be allowed to buy insurance through the public option. Whether that public option was even used or not, it would foster competition and result in better prices for those consumers. The Fed essentially created a public option in the money markets. They saw that there was lack of competition in the money markets, and they were going to provide the bid. Pass-through to wholesale rates improved greatly. The Fed has been able to successfully raise rates and keep the federal funds rate in its target range. Potter in May 2016 said, "We have now seen in practice that changes in administered rates can effectively move market rates, both because effective competition helps bring administered and market rates closer together, and because the mere existence of administered rate facilities like the RRPs I mentioned earlier can affect competition." Again, the same argument about the public option in the ACA. Perhaps more clearly, this diagram from a senior thesis at Yale this spring, the bottom line shows the ONRRP rate, and the blue line is the I skipped ahead one. I'm sorry, this didn't have the additional chart that I had tried to insert at the last minute. That's Sorry about that. But the ONRP essentially is right below the federal funds rate. So the ONRP has served as an effective floor to the funds rate. And many analysts believe that it's the ONRP rate that pushes up the Fed funds rate above the ONRP rate because it's offered to lenders, and they can negotiate with banks for higher rates. So that's on the rate side. Narrow banks have been shown to inject competition into the money markets. Very important goal of the government. When it's providing this interest on reserves, it's very important to have a competitive market. Paul was suggesting that the IOER is a subsidy. It's only a subsidy to the extent that competition falls short of perfect competition. If we can inject more competition into the market, that is my belief on how we can cure this subsidization problem that plagues the IOER. There's another issue with these large depositors, and that has to do with financial instability. Robin Greenwood, Sam Hansen, and Jeremy Stein in 2016 said that a key threat to financial stability is the tendency for private sector financial intermediaries to engage in excessive amounts of maturity transformation, to finance risky assets using dangerously large volumes of runnable short-term liabilities. This is a diagram from a New York Fed publication in 2010, and the red line shows the amount of these shadow bank liabilities on net, where they try to avoid double counting. It exceeds the amount of banking assets. These liabilities are really the alphabet soup that we all lived with for many years. MBS, ABS, GSE liabilities, CP, repos, money market mutual funds, medium-term notes, discount notes, ABCPs, CMOs, CDOs, CDO squareds, option notes, VRDOs, ARS, and so on. So the private sector came up with a plethora of seemingly safe but runnable short-term securities, and it was posed an extraordinary vulnerability to the United States economy. Most all of these were run and were extraordinarily important progenitors of the financial crisis. Another diagram that shows this, if you focus on the middle diagram, this is a paper from 2015 on the money market mutual fund run following the breaking of the buck of the reserve primary fund. That line that heads south immediately there is institutional investors in prime money market funds. The gray lines in the middle are the retail investors. So retail investors are very sluggish. They're very stable. It's the institutional investors, these large investors, that run exactly the risk that Greenwood, Hansen, and Stein were discussing. Furthermore, institutional investors are very rate sensitive. This diagram shows the proportion of reserve holdings by domestic and foreign banks. If we look at the second line on the diagram, the second vertical line, that's April 2011 when the Federal Deposit Insurance Corporation changed its assessment formula to change from assessing banks just on deposits to assessing bank holding companies on all their liabilities. So after that point, if a domestic bank borrowed federal funds, that would increase their FDIC assessment. In light of that, about $400 billion of reserves were transferred from domestic to foreign banks within the next few months. And that was the big increase in the area, the red area, where foreign banks are holding reserves because they have lower balance sheet costs. So they attracted the large share by these wholesale depositors. Now, furthermore, these narrow banks can be a shock absorber. This is getting to the financial stability aspect of it. Here's a case in point. The ONRP supported financial stability, as Simon Potter reports in April 5th, 2017. In October 2016, the entry into force of new SEC rules for money market funds. They could also make prime funds less attractive. Substantial amounts were expected to come out of prime funds into government-only funds. The size of the reallocation ended up being quite a bit larger than most had expected. About $1 trillion of assets had migrated from prime to government funds by late 2016. The good news is that the ONRP facility served as a shock absorber for overnight rates. Government funds increased their use of the ONRP during the transition. Because of the availability of the ONRP, government funds knew that they would be able to temporarily place some of the new funding they received at the ONRP facility. As a result of this elastic provision of risk-free investment opportunity, overnight secured and unsecured rates were only modestly affected by these large flows. This is really a fascinating case in point of how a narrow bank can assist in financial stability precisely because it offers a safe deposit facility. Now, to address this financial stability concern, Greenwood, Hansen, Stein make the argument that by expanding the overall supply of safe short-term claims, the Fed can weaken the market-based incentives for private sector intermediaries to issue too many of their own short-term liabilities, this excessive maturity transformation. Greenwood, Hansen, Stein essentially say that if the Fed would get into this business, it can crowd out these VRDOs, ARS, and so on. But this suggestion ignores the possibility of narrow banks, private sector narrow banks, designed for the purpose of providing a safe deposit facility to large depositors to accomplish this task. Other analysts, Joe Gagnon and Brian Sack, in 2014 recommended that the Fed expand the role and importance of the ORP in monetary policy implementation. So they see this very importantly to improve monetary policy and to improve this rate competition that we've reviewed. They pointed out many advantages of an expanded ONRP. It enhances the integration of financial markets. It could save taxpayers money. It maximizes the benefits of quantitative easing. It could mitigate shortages of treasury collateral. It provides a useful reference rate for financial markets. It improves the efficiency of liquidity management for the financial system. It appropriately ignores the quantity of money. It accords well with regulatory changes. And we believe that the most appropriate choice may be to set the IOR, the interest on reserves, and the RRP rates equal. There's just one problem with these suggestions. The Fed is not intended to compete with the private sector. In fact, the Fed's policy normalization principles and plans in September 2014 said during normalization, the Fed intends to use an overnight reverse repurchase agreement facility and other supplementary tools as needed to help control the federal funds rate. So first of all, they're saying that the ONRRP is necessary to the implementation of monetary policy. It's needed. They can't do without it. But they go on to say in the minutes from June 2014, in addition, a number of participants noted that the relatively large ONRRP facility had the potential to expand the Federal Reserve's role in financial intermediation and reshape the financial industry in ways that were difficult to anticipate. Finally, a number of participants expressed concern about conducting monetary policy operations with non-traditional counterparties. So they go in and attract 160 bank customers, and they're concerned that this is new. They're competing with banks. They should be concerned. And the other quotes go on to suggest this discomfort. And the final quote in July says, participants generally agreed that the ONRP facility should be only as large as needed for effective monetary policy implementation and should be phased out when it's no longer needed for that purpose. Participants expressed their desire to include features in the facility's design that would limit the Federal Reserve's role in financial intermediation. So the Federal Reserve is not going to do this role that Greenwood, Hansen, Stein, or Gagnon-Sack suggest. The alternative is private sector narrow banks. Private sector narrow banks can accomplish these objectives of increased competition for pass-through of IOER, integration of money markets, taxpayer savings, and other benefits as suggested by Gagnon and Sack, while at the same time providing the systemically safe deposit facilities for flighty wholesale depositors as suggested by Greenwood, Hansen, and Stein. Narrow banks assist in all of these desired ends. In particular, narrow banks can improve deposit market competition by expanding the set of depositors to include institutions that aren't necessarily included in the Fed's narrow banks. Because of their safety, narrow banks pose deposit market competition to the largest banks, and like the ONRP, would not necessarily attract retail deposits. Now, what are the downsides to private sector narrow banks? What have been suggested as potential downsides? Well, Cicchetti and Schoenholtz in 2018 said, we worry that narrow banks would shrink the supply of credit to the private sector, something that Paul mentioned in passing about a narrow bank system. But again, TNB is not suggesting a narrow banking system. It's simply saying, let's create a narrow bank. But in a paper that I wrote with Antoine Martin and David Ski, we show that where interest on reserves, and there's this perfect intermediation of interest on reserves, much like narrow banks, increases in the quantity of reserves, so increases in narrow banking, have no effect on bank lending. It simply sets the price, the safe interest rate. If a loan has a risk-adjusted net present value above the safe interest rate, that loan is going to be made by the banking system. It's a better deal. They can make more money rather than putting their money in the Federal Reserve. What the narrow bank does, of course, is compete with treasury bills, not with bank lending. Furthermore, we don't have to theorize about this. We can ask what happens in fact, because we've been living in the narrow bank world for 4 years. Simon Potter in February 2016 said, lending volumes in secured and unsecured money markets have been stable, suggesting that the Federal Reserve's facilities have not displaced activity in the private sector. Now, that's an amazing fact that we have to take into account. Certainly, what this points to is the first effect of narrow banks is to raise interest rates for competitors, not to displace quantities of activity in competitors' activity. So the transmission of the ONRRP rate into retail deposit rates, as you saw in the first chart that I provided, has been extremely muted. Extremely muted. So retail deposit rates have not been affected by these narrow banks, and I don't believe that it has affected the level of bank lending much in the way that Potter has pointed out that it hasn't affected activity in wholesale money markets. Cicchetti and Schoenholtz also suggest, we worry that narrow banks would aggravate financial instability during periods of stress, just in contrast to Potter's case study of how narrow banks improved financial stability during stress during the change in the money market mutual fund regulation in 2016. Now, first of all, narrow banks, where do people run into today? Well, they run into government-only money market funds and into too big to fail banks. Narrow banks will not eliminate government-only money market funds nor too big to fail banks. They'll still be there for people to run into. Further, narrow banks had little inflow capacity relative to existing alternatives. It takes days to acquire a new customer. They have to sign a deposit agreement and so on. There's not going to be any overnight run into a private sector narrow bank. Furthermore, existing depositors could be throttled if that would benefit system stability. But again, we've been living in this world for years. How does the Fed and its narrow bank facilities handle this risk? Drawing on Potter again from February 2016, we address the risk of sudden surges in take-up in a couple of ways. For example, we can employ vigilant market monitoring to detect any such shifts and allow the FOMC to formulate a response. We also use counterparty caps and can use an aggregate cap. The only aggregate cap in the Fed's narrow bank has been the amount of securities that are available for lending, about a $2 trillion cap. So the cap has never been approached anywhere close. Now, if this is a concern, if there is a concern about this run in a flight to safety, then there is a risk to financial stability that could, of course, be mitigated by having large flighty depositors already holding narrow bank deposits before the potential flight. So this is related to Greenwood-Hansen-Stein crowding out idea, but it's a different point. That if flighty depositors are a problem, then we need to create safe deposit facilities for flighty deposits in the first place. Then there will be no flight. And so narrow banks directly address this issue in a number of ways. To sum up, TNB USA was designed to pay higher than currently available interest rates on the safe deposits of institutional investors. It would improve competition in the deposit market and other money markets, strengthen the transmission of monetary policy, and improve financial stability. The legislation and Federal Reserve actions instituting the payment of interest on reserves were fundamentally predicated on interest being passed through to depositors. The introduction of IOER removed the much reviled reserve tax, but was not intended to become an affirmative bank subsidy to large and foreign banks. Narrow banks are an important component of the efficient payment of interest on reserves, as the FOMC's statements about the necessity of the ONRP, a narrow bank in all but name, demonstrates. The time has come to allow the formation of private sector narrow banks, not just public sector narrow banks, as indeed this is allowed and required under federal and state law. Thank you very much.
Thanks, Jamie. Now on to our panel of experts. I'm going to introduce them alphabetically, and they'll speak alphabetically, so please come up. First to speak will be Robert Eisenbeis, who is Vice Chairman and Chief Monetary Economist for Cumberland Advisors. Prior to joining Cumberland Advisors, Dr. Eisenbeis was Executive Vice President and Director of Research at the Atlanta Federal Reserve Bank of Atlanta. Dr. Eisenbeis has also held positions as the Wachovia Professor of Banking at the Keenan Flagler Business School at the University of North Carolina at Chapel Hill. He also held senior positions. He was an officer at the Federal Reserve Board and at the FDIC. He's a member of the Shadow Financial Regulatory Committee, the Financial Economists Roundtable, the National Association of Business and Economics, and the Wharton Financial Institutions Center. He has a PhD from the University of Wisconsin. Following Bob, speaking after Bob, will be Oliver Ireland, who's a partner at Morrison & Forster, LLP. His practice focuses on retail financial services and bank regulatory issues, including consumer protection regulations and Consumer Financial Protection Bureau powers and initiatives, and all types of payments transactions, including compliance with National Automated Clearinghouse Association rules. Mr. Ireland's practice also includes regulatory issues applicable to bank and thrift holding companies and a whole list of other things, and you could see it online. Mr. Ireland, Ollie and I go way back. He was at the Federal Reserve Board where he was an Associate General Counsel, and for full disclosure, we worked together on margin requirements and other issues back in the old days, back in the last millennium. Morgan Ricks is a professor at Vanderbilt Law School, specializing in financial regulation. From 2009 to 2010, he was a senior policy advisor and financial restructuring expert at the U.S. Treasury Department, where he focused on financial stability initiatives and capital market policy. Before joining the Treasury Department, he was a risk arbitrage trader at the Chicago-based hedge fund Citadel Investment Group. He previously served as vice president in the investment banking division of Merrill Lynch & Company, where he specialized in strategic and capital-raising transactions for financial services companies. He began his career as a mergers and acquisitions attorney at Wachtell, Lipton, Rosen, and Grants. So now to our panel of policy experts. Bob.
Thank you very much, Paul. It is indeed a pleasure to be here and to have a chance to meet friends that we've had long-time acquaintances with. Jamie has given us a very broad overview of really the case for narrow banks and particular the kinds of problems and issues that they're designed to solve. I'd like to go into some of those issues in a little bit more detail, not necessarily with the degree of specificity that he's talking about, but rather try to focus on one or two of the key problems that narrow banks are designed to try to address. I want to get to my slides. Here we go. want to give a little bit of background about what the monetary policy implementation world looked like before the financial crisis. And that was a situation where in 2006, for example, the Fed had a balance sheet of about $90 billion. And the real determinant of the size of that balance sheet was an attempt on the part of the Fed to keep the currency to GDP ratio relatively constant. And of that, excess reserves and required reserves were a very small proportion. In fact, required reserves really weren't effectively a binding constraint on institutions. That mainly the larger institutions in particular met required reserves by essentially holding cash in their ATMs, among other things. The real determinant of the volume of reserves that they held at the Federal Reserve were so-called precautionary reserves to ensure that they had enough liquidity to meet certain transactions and other kinds of unanticipated demands for funds. But it certainly wasn't, their balance sheets certainly were not constrained by what the amount of required reserves were. And there's a long history of why that's the case and how the Federal Reserve attempted to deal with some membership and other kinds of problems, which is an aside to which perhaps a discussion for another day. As far as monetary policy was concerned, it was really implemented by managing the small amount of excess reserves through transactions on the open market desk and the overnight Fed funds market, designed to maintain the particular target that the open market desk had set. After the financial crisis, what's changed? Well, today the Fed's balance sheet is $4.1 trillion, of which only 41% is determined by currency outstanding. The rest are now excess reserve balances, and these two now account for about 84% of the Fed's total assets. Reserve holdings are about 92% of bank cash holdings at this point in time, substantially different than it was before the financial crisis. The Fed now sets, and as Jamie went into some detail describing how the Fed now sets the overnight rate on reserves. There's a corridor in place capped by the discount rate at the top, and the Fed has a Fed funds target rate of that it sets between the two quarters of the discount rate and the IOER, which is designed to be a floor for policy. Daily open market policy is now implemented through the reverse repo transactions that Jamie described in some detail. Just to sort of give you an idea of who the real users are, this table amplifies some information that Jamie had already provided. And what it really shows is that the main beneficiary of this particular facility has been money market mutual funds, as he has mentioned. They're the ones that take the most advantage of this reverse repo program. Primary dealers are also involved, and there's a long history of primary dealers and their role that they played in monetary policy, both before and after the financial crisis. There are now about 23 primary dealers, and over half of them are foreign institutions, and that raises some issues that I'll come to in just a couple minutes. What's changed? Well, as we've already said, we have a Fed funds target and a policy that's determined by the floor on interest on reserves. And the effective funds rate, however, and Jamie had some charts on this, is oftentimes below the floor. Why is that the case? The main lenders in the Fed funds market at this point are Freddie, Fannie, and the Federal Home Loan Banks. They're able to hold deposits at the Federal Reserve, but may not receive interest on those deposits. So what they do is they lend in the overnight market mainly to other institutions. Who do they lend to? Well, the main institutions they lend to are foreign banks. Foreign banks are also allowed to hold accounts at the Federal Reserve, but they can borrow from Freddie and Fannie and the home loan banks in the overnight market and deposit those funds at the Fed and earn an arbitrage return. Volume was quite large in this market, but it shrunk from about 200 billion to about 60 billion now. Now, in this arbitrage situation, what's the problem that TNB proposes to solve? It's really a simple model that would accept wholesale deposits, mainly from the GSEs and money market funds, and place them in a master account in the Federal Reserve, earning the overnight rate. The payment on interest on this whole transaction is nothing but an intra-governmental transfer of funds from the Federal Reserve to the GSEs. The GSEs and the Federal Reserve remit any excess returns that they have back to the federal government and to the Treasury. So it really is almost a wash as to whether those funds are remitted from the Fed or whether they end up getting taken from the GSEs and the home loan banks back into the Treasury. But there's an arbitrage situation here that the TNB proposes to interpose itself in to solve this problem, which could be potentially addressed in many other ways. I want to be sure that I get to the next page. Now, what about the Fed's reverse repo problem? First of all, we need to understand that calling it a reverse repo problem policy is really a misnomer. The Fed's terminology is talking about the reverse repo program from the perspective of the counterparty, not from the Federal Reserve's perspective. The Federal Reserve is actually selling securities to the private sector overnight and then redeeming them at the repo rate. So it's actually, the Fed is actually repoing transactions into the marketplace. But I have a sort of a Yogi Berra description of repo, because it's sort of like patting your head and rubbing your stomach at the same time. When is a repo a reverse repo? The answer that Yogi would say is, well, when you're on the other side. So the situation we have here is that TNP, the narrow bank, okay, would take money from the money market funds who are only able to deal with the Fed at the reverse repo rate of 2%, pay them 2.20 less a spread, and give the money market funds a backdoor to depositing excess returns at the Fed with a higher rate. So it's an intermediary performing an arbitrage function, mainly for the GSEs and money market funds. Now, remember, money market funds only exist because of an historic accident, and that is because of Reg Q. We heard a little bit about Reg Q from Paul, that if it weren't for Reg Q, money market funds probably never would have come into existence in the first place. So let me talk about what I think are some other issues that are related to this whole particular proposal. Not a problem with it, but just a set of issues that I think are on the table. First and foremost is the fact that there's the need to sterilize these excess reserves in the banking system. If, in fact, the money multiplier associated with required reserves had been applied by the domestic banking system, every dollar of excess reserves would support about a $20 increase in the money supply. So from the Federal Reserve's perspective, from a policy perspective, this huge amount of excess reserves represented a potential inflation fire that somehow had to be neutralized. Well, the foreign institutions, by virtue of this arbitrage activity going on between the home loan banks and the GSEs, solve part of that problem because they presently own about 35% of the excess reserves. And at an earlier point during the financial recovery from the financial crisis, 2010, 2011, and 13, they held about 50% of the excess reserves. These institutions, think about it from their perspective. In Europe, they would have to pay 70 basis points approximately to their central bank to hold a reserve at the central bank. A negative interest rate in there versus a positive interest rate in the United States. It's a no-brainer for them to take their funds through the magic of transformation and deposit them at the Fed and earn the federal fund, the interest rate on reserves. That's a risk-free arbitrage as far as the foreign institutions are concerned. That's money in U.S. going to foreign institutions. Would be a problem for some people. It's a risk-free arbitrage, and on top of it, those deposits at the Fed satisfy the Basel III liquidity requirements on some of their funds. So they have several advantages over U.S. institutions in arbitraging and several incentives to arbitrage that circumstance. They have lower costs. As Jamie had mentioned, they don't have to pay the 15% tax from the FDIC insurance premium on their total asset holdings that would be associated with U.S. banks. These institutions aren't the ones who are going to be lending to small business or lending to business in the United States. So their role in this market has effectively sterilized a huge portion of the excess reserves that would otherwise present a policy problem for the Fed policymakers. Now, just to sort of emphasize, this shows the distribution of firms that have been holding excess reserves, small institutions, U.S. institutions. The dotted line that you see, which is on the right-hand scale, shows what was happening in terms of cash asset holdings before the financial crisis. Almost zero. You can almost hardly see it at the bottom, and suddenly that situation has blown up. Other issues. We had this supplementary coverage ratio that was put in place, which has resulted in estimating cost to U.S. banks of holding cash as much as 35 basis points. Another issue is how big should the Fed's balance sheet be? Should it return to normal? What would happen to TNB? The balance sheet, and I have provided some estimates as to what the runoff in the balance sheet would look like to achieve the same currency to GDP ratio today that it had before the financial crisis. The balance sheet would have to be about $1.87 trillion. So the shrinkage in the balance sheet is not necessarily quite as large as some people hold. Then on top of it, you would add whatever sort of excess reserves or required reserves would be on top of that. So the question is, how big should the balance sheet be? And I've got to wrap up, but I'll make just a couple other points. How can we solve some of these problems? Now, number one, maybe we should think about paying interest on reserves for Freddie and Fannie and the home loan banks. That might solve problems, might require some legislation because they're not permitted to receive interest on reserves at this point in time. We could change the way the desk operates, particularly with regards to how it used to operate in the federal funds market. It made one transaction a day. I asked the people, what do you do the rest of the day if you only made one transaction a day? Well, what they could do is continually buy and sell Fed funds. There's other things that they could do as well from a regulatory perspective. A lot of these issues that we're dealing with in one way or another are a creature of a mix of regulatory policies, history, legislation that have created a lot of these arbitrage incentives. We can talk about more of these issues, but I'll stop at this point.
Thanks, Paul. And I'm going to come at this issue from a little bit different direction. I'm a lawyer, I'm not an economist. I spent a lot of years as a lawyer for the economists at the Fed and listening to them talk about monetary policy techniques, as we've been listening to for a while. And the story changes over time. It's not consistent. There are different techniques of conducting monetary policy. So I'm going to look at the world for a minute as it is today. You have a process of paying interest on excess reserves. The theory, as I understand it, in lawyers' lay terms, simple terms, is it's basically a floor, designed to be a floor on the interest rates in the market. TMB has applied for a Federal Reserve account, and the Federal Reserve has not given TMB an account. And that issue is currently in litigation. And the question is, what's going on here? Why aren't they doing it? There has been historically an attraction to having Federal Reserve accounts. The Federal Reserve, membership in the Federal Reserve and having a Federal Reserve account was optional until the Monetary Control Act of 1980. What you got from the account, you got an account at the Fed, which is a safe haven. There is no credit risk to that account. Some people claim it has sort of a halo effect, that you're safer if you have your money at the Fed. There's some integrity to it, and at any rate, the key feature is no credit risk. Historically, that account also came with discount window access. That's not really an issue here. And it came with access to price services, which is also not really at issue in TMB. The Monetary Control Act changed the voluntary system where you had national banks had Fed accounts, and state banks that chose to be members of the Federal Reserve System had Federal Reserve accounts and were required to keep non-interest earning reserves, which was a big tax. Monetary Control Act expanded that to all depository institutions, which included thrifts and credit unions and non-member state banks, because the Federal Reserve said it was losing control of monetary policy because people were fleeing the Federal Reserve System and not holding reserves. And this was followed by a very steep increase in interest rates. At the Fed actually preceded a bit by the steep increase in interest rates. 79, 80, 81, the Monetary Control Act was 1980. That expanded the access to Fed accounts, broadly speaking. There have been, in that world, there have always been some unique institutions that had different business models or were created for special purposes that wound up getting Fed accounts. About the same time as the Monetary Control Act, a little bit after that, trailing by months, there was a bailout of Chrysler Corporation. Chrysler was in trouble. There was a loan guarantee board, federal loan guarantees for Chrysler. And one of the problems Chrysler had, aside from the loan guarantee board, was that it collected checks for its vehicles. The way it got paid for a certain number of the vehicles it sent to dealers was that it drew a check on a letter of credit issued by the dealer's bank when it shipped the cars to the dealer. And they deposited that check in National Bank of Detroit. And the loan guarantee board comes along, Chrysler's in trouble. National Bank of Detroit said, we don't want those checks. We think you're going to fail. If you fail, those checks are going to come back after you failed, and we're not going to be able to charge them to your account. We're going to be holding the bag. We're cutting you off. Martha Seeger was head of the banking department in Michigan at the time. She created a special purpose bank, Automotive Financial Services, Inc., which was a depository institution, got access to Federal Reserve services, and gave the checks to the Fed, who would also wind up holding the bank. I was at the Fed in Chicago at the time. We took a large clearing balance. It was started out at about $105 million, which was about 5 days worth of checks. And so we thought we weren't at risk from the process. But it was a special purpose bank designed to take advantage of the features of a Fed account at the time. It was accepted by the Chicago Fed and approved by the board. This is not new. In that same period, I can remember talking to the supervisors at the Chicago Fed and came across a phenomena at the time that they called portfolio banks. Now, Illinois was a unit banking state, and so you had a lot of small banks around the state. You didn't have statewide branching. You could have one branch within 1,500 feet of your head office. That was it. And the portfolio banks were banks that took deposits, served their customers, and invested in treasury securities. They didn't make loans. That's all they had. Treasury securities then were paying double-digit interest rates. It was a good business model. It was a safe business model. It worked. Nobody threw them out. A few years later, in 86, 87, the board started to get concerned about the phenomena of banks that were not banks under the Bank Holding Company Act. And it was a phenomenon known as non-bank banks, and the board didn't like those and thought that there was a problem with them and didn't want to allow them to have access to Federal Reserve Bank accounts and Federal Reserve Bank services. I had left the Chicago Fed and I was at the board at the time, and we looked at that pretty hard, and there were legal issues as to whether or not you could shut people off from that. I'm going to touch on those, my perception of those a little bit later on. I'm not involved in the litigation, but just what we thought when we saw that. There have been a couple of other references along the way. People have referred to reserve requirements, required reserves, as the reserve tax, where you had to maintain sterile reserves. At one point in the early 90s, that was about $45 billion in required reserves. That number went down to about $5 billion. That number went down to $5 billion with the full consent of the Federal Reserve Board. People were developing sweep accounts that could reduce the reserve requirement artificially. We looked at that. We looked at the current rules. They were legal under the current rules as they were structured. We sent a memo to the board and said, should we change the rules? The answer came back no. So we let the reserves ran off because of that. That wasn't something that the board didn't have control over. We let the reserves go down. We're now raising the reserves back up through paying interest on reserves, arguably a floor on the interest rates. Monetary policy, as I said, differs. We've seen it's ballooned the Federal Reserve balance sheet. The other effect it has is it has made Federal Reserve accounts, which were previously attractive for safety and services reasons, even more attractive because they're now attractive for interest rate reasons as well. There are a lot of people out there in the marketplace that would like to have Federal Reserve accounts. We have seen litigation come out of a credit union that wanted to handle marijuana, money proceeds of marijuana businesses, and to get access to Federal Reserve services. The Federal Reserve is not handling the proceeds of marijuana transactions because they think that's illegal under federal law. But that was one interest. There is a whole issue about marijuana banking that Congress may resolve sooner or later. Other people are also interested in those accounts. Fintechs, in particular, see business models either in the lending area or in the payments area that they think would benefit from having access to Federal Reserve accounts in terms of price services or in terms of perceived stability. And one of the things I suspect the board is worried about and the Fed is worried about here is who else is going to come in and ask for an account, and what kind of account are they going to ask for, and what's their business model going to be. Well, what are their choices? One of the things we found out, at least in the law as it existed in the late 1980s, was you couldn't take one statute as a federal agency and use it to enforce another statute unless that was contemplated by Congress. So if you didn't like the way a non-bank bank, because it wasn't a bank under the Bank Holding Company Act, you couldn't then use the Federal Reserve Act to restrict its account. There were legal problems with doing that in exercise of statutory powers. There may also be constitutional issues. You're taking state action. You're the government. You're restricting government benefits. They're equal protection, due process kind of claims. The issue of the narrow bank, as Jamie McAndrews has put it to the Fed, I think is an interesting one. We've heard a lot this morning already about monetary policy and the details of monetary policy and how it's working and how the narrow bank fits into that. My own take on it as a non-economist lawyer is, if anything, it's probably pro-stability. I don't see the policy problem there. I'm yet to hear what the Federal Reserve thinks the policy problem is with the narrow bank. And as a technical legal matter, if people have the resources to carry the litigation forward, it's not clear to me how they win this lawsuit. But things are still playing out. They will play out over some period of time, but I think it's something that people need to watch. If the Fed is going to establish policies such as interest on reserves, it's going to have to live with those policies. And if it doesn't like the results of the policies, the answer is to think about the policies more before you create them, rather than try to become selective as to how you administer them after the fact. Thank you.
Thanks, Al. Morgan Ricks.
What's the best way to get over here? Come on.
Great. Well, thank you for having me, Paul. Great to be here. And I'm going to essentially scrap my remarks because they're somewhat duplicative of some of what the other panelists said. So I'm going to offer some reactions, and I can be fairly brief about this. I was going to spend a couple of minutes on the merits of the legal case itself, but I think I'll set that aside, and we could come to that in Q&A if we want to. And I'll focus on the policy issues, which have been the main source of discussion here. So the Fed has raised policy concerns with the chartering of the narrow bank, and they've been quite vague about it. There seem to be two. The first is financial stability issues, and the second is monetary policy and interest rate control issues. And let me just say a brief word about the stability issues, because I think I agree with everything that the others have said. I don't, if anything, the narrow bank should be pro-stabilizing as a force, mainly because, as Jamie mentioned, it should be expected to crowd out other money substitutes that are unstable. The narrow bank should shrink the size of the money substitute markets, all these alphabet soup of things, ABCP, auction rate securities, VRDOs, repo itself, Eurodollars, and all the rest. Those markets are money substitute markets, and they exist to satisfy money demand, because there is no pure kind of money that a big institution can own. Of course, they can own paper currency, but that's not really practical. And so the existence of all these markets is predicated on the fact that no one's going to hold a multi-billion-dollar bank account at a single bank, because deposit insurance runs out at $250,000, and no large institution wants to assume that kind of risk of counterparty exposure. So the lack of existence of base money for the broader institutional segment of the marketplace is the reason these deposit substitutes exist, and Jamie would be creating essentially a pass-through for base money. offering a rate that is at least equal to and maybe north of what you can get in the institutional money market. So I think without question, or there's very little question, that the crowding out that Greenwood, Hansen, and Stein referred to or argued for in their very influential paper from a few years ago would apply here to the narrow bank. And so it should be a pro-stabilizing point. I would also add two more things on that, on stability. First, these institutional counterparties are already running. Where are they running? They're running to the Treasury market, and they're running to J.P. Morgan when things get hairy. It's not clear that the existence of a narrow bank would significantly exacerbate that problem. Finally, I would just say, if anything, this argument by the Fed that this would be destabilizing is sort of an indictment of our current system in which we rely on unstable, privately issued deposit substitutes to satisfy money demand. On the interest rate control and monetary policy side, it's sort of puzzling the Fed would oppose, to the extent I understand their argument. They don't spell it out in much detail. But it's puzzling they would oppose the narrow bank on these grounds, as the other panelists have pointed out. The whole theory here is that IOER is supposed to pass through, and pass-through has been pretty lackluster. Even in institutional markets, it's been lackluster, which was the reason for the creation of the reverse repo facility itself. I would just note the Fed says the reverse repo facility is about the Fed funds market, but that seems pretty unlikely to me that it's really about Fed funds, because if it were about Fed funds, the Fed would have supplied the facility only to the GSEs, because the only reason the Fed funds rate falls below IOER is because the GSEs don't receive interest on their balances. So the existence of the reverse repo facility was really about tri-party repo rates and broader money market rates, and not the Fed funds rate. In any case, the point is to get better pass-through. That's the reason we created the reverse repo facility. And the narrow bank should improve pass-through. And that should be a good thing from the Fed standpoint. I was going to refer to the Powell-Henserling exchange that Jamie referred to, where about retail rates being sticky on the way up. Jamie already referred to that. I mean, come on, it's been 3 years since liftoff at this point. How much of a lag is appropriate for retail rates? This question of subsidies. Just a couple more comments. Jamie referred to subsidies, as did Paul. Fed officials have vociferously opposed the idea that IOER should be viewed as a subsidy to banks. And I think, to the extent banks are have access to a privileged asset that the rest of us don't have access to, and that asset is, as Bob mentioned, quite attractive. And they're not passing the interest rate through. That is sort of de facto a subsidy. Let me conclude by just asking a question, though, maybe a little bit of a challenge to Jamie, which is whether the narrow bank really is a solution or is the optimal solution to this set of problems. He referred to switching costs and lack of competition as being potential reasons why the banking system wasn't passing policy rates on to depositors. I don't really see why that changes so much when Jamie comes along. I mean, Jamie's going to be one more bank, and presumably he's a profit maximizer. He is not in the business of charity. He is going to charge what the market will bear for his services. And it's not obvious to me. I mean, maybe he'll pre-commit to some level of fees that he'll charge, or a spread between the IOER rate that he will offer, the IOER rate that he'll receive and the deposit rate that he'll offer. But presumably that will be, he'll charge as much as the market will bear for that, which may be just allowing his own depositors to earn slightly more than they could otherwise earn with the banking system. So adding one more bank to the mix doesn't solve the problem, at least to the extent the problem has to do with lack of competition. I mean, his rates, there's no lower level of transparency with respect to bank deposit rates in general and the rates that the narrow bank will offer. So I just want to suggest conceptually, and I'll conclude with this, that to the extent that imperfect competition and switching costs and what have you are the reasons for the lack of pass-through, the answer here, or another answer, would be to allow greater access to reserve balance holdings. In other words, accounts directly held with the central bank. Paul referred to subsidies going to banks. The cleanest way to get rid of the subsidy is to eliminate the special privilege. The special privilege here is that only depository institutions have access to accounts at the central bank. Okay, some government entities and GSEs and what have you do also, but essentially banks have access to this special asset. If we're really concerned about subsidies, then the more appropriate answer will be to open it up to a much broader clientele. In other words, another way of thinking about this, paper currency is an equal access asset. It is an open access resource that we can all hold, but reserve balances are a privileged asset that are only available to the banking system. And that dichotomy doesn't exist by nature. It's a product of a policy choice. So another solution here would be expanded access to central bank accounts. I'll stop there.
A couple minutes to respond to the
Yes.
comments of the panel, please.
Thank you, Paul, and thanks, Bob, Ollie, Morgan. These are great comments. I'll just say a couple of things. One, to kind of put my thoughts in perspective as I answer some of your comments, is that the payment of interest on reserves, which was, again, passed by Congress in 2006, is not related to the crisis, in a sense. The Congress, as a result of decades-long issues and so on, and recounted well by Ollie, the decrease in reserve balances and so on, had to address the reserve tax at some point. So the reserve tax was ended with the payment of interest on reserves. This was a key watershed in U.S. banking. It was coincident with the crisis, but it was unrelated to the crisis. And so we have a hard time separating out these things in our mind. We think somehow the payment of interest on reserves is related to the crisis. In fact, it was a policy that was determined more by these long-term sectoral issue of the reserve tax. Now, one thing Bob said that I'd like to point out is he said one way to address this would be to pay interest on reserves to Fannie and Freddie. That wouldn't address the problem of this lack of competition in banking. So I didn't quote some of Simon Potter's other comments in his speeches where he said the implementation of monetary policy goes beyond the federal funds rate. And he pointed out some of the things that Morgan did, that we had to get farther than just the federal funds rate to bring all market rates up, all wholesale money market rates up. And that's what the Fed's narrow bank, the ONRRP, effectively did by including the money market funds. So the money market funds were a key clientele for this public option. Ollie pointed out in passing, I don't think he really meant this, but he was talking about how the interest on reserves gives another reason for banks to hold reserves because it's an interest-earning asset, and that's correct. And he mentioned in passing that it ballooned the Federal Reserve's balance sheet. It's not the interest on reserves that ballooned the Federal Reserve balance sheet. It certainly does give another element of demand for reserves by banks, which is a good thing, so the banks can hold more reserves, be in a safer position than the incentives they had earlier to minimize the reserve holdings, as Ollie pointed out, with sweep accounts and things of that sort. And then to address Morgan's fundamental question, is this the best solution or an optimal solution to have the narrow bank? Well, it's certainly a step in the right direction, I'll say, trying to be as objective as I can. But we would expect that copycat firms would enter, and that we could look forward to a narrow banking sector. And by the way, I'd just like to point out, TNB has no power or interest in reducing other firms to enter this sector. That's the Fed's issue. They're stopping firms from coming in this sector, not TNB. So we could expect that there would be a sector of the narrow banks. And I think it is important to do first things first. And the first thing has to do both with this lack of competition at the wholesale level that required the Federal Reserve to create a narrow bank and expand greatly an existing narrow bank, and in order to get rate competition in the wholesale market, and to take off the table this extraordinary financial stability risk that these large flighty depositors are a true vulnerability in our financial sector. And narrow banks can do that. Judging from the Federal Reserve's narrow banks, it hasn't passed through to retail depositors. And that's Morgan's question. Will you pass through to retail depositors as well? I think that there's a better chance for narrow banks in the private sector to pass through to retail depositors, but I don't expect that we will have, we'll be taking deposits out of banks, deposits that are covered by federal deposit insurance. They're perfectly safe, and which they have payment services and other reasons for those deposits to be there. And so for those reasons, I agree with Morgan that there could be limits to the effect that narrow banks would have on how far down in the retail deposit market its effects would be felt. To address this, while I was at the Federal Reserve, I suggested an alternative policy which was called segregated balance accounts. I referenced a paper by Rod Garrett, Ed Nozel, and myself, which describes segregated balance accounts. That would allow any bank in the nation to have a narrow bank account. And I think that the issue of this subsidy is not so much the special privilege of banks having access to the Fed, surprisingly enough, but it's the lack of ability that banks have to segregate all of their risky assets from their reserves. And if banks could do this through a special account established by the Federal Reserve, then every bank would be able to create a narrow bank. And what we know in economics is that if we compete with a homogeneous product, then price competition will be extremely strong. So if all banks could have the ability to create an account that would be homogeneous, consisting only of reserves, then we could expect that there would be very strong price competition in that sector. So that's another alternative. The answer that Morgan suggested is that we need to expand the public option, and that's another alternative. The Federal Reserve or some agency could create something akin to postal banks and expand the public option all the way down to compete with existing banks in retail accounts. That's a broad question. The Federal Reserve went ahead and started a public option. They didn't consult Congress about starting the public option. They just said, we're going to start the public option. We're going to go into competition with banks. But we'll limit our competition. We won't pay those money market mutual funds exactly what we pay banks. We'll pay them a little bit less. And they have not been called to answer, why did you go into competition with banks? But I think that they would be called to answer if they just started a public option. So that's something that I think should be discussed more broadly within Congress about how much should we rely on public options in this market versus private sector solutions. Thanks very much.
Thanks, Jamie. I want to circle around a little bit before I ask Jamie a question, and I want to try to put in English some of the monetary jargon that's been thrown around, and I'll give it my best shot. And I know there's folks in the audience who I have my eyes on right now who might be able to do a better job, but they'll do it next week. So at an event here next Monday night, George Selgin's got a new book out called Floored, which he deals with a lot of these issues. But anyway, if the IEOR, the interest the Fed paid on reserves, were zero, TNB wouldn't be here today. They wouldn't be following they wouldn't want to open up a bank. There'd be no issue here. You have to pay a rate that's positive. Now, when the Fed started paying interest on reserves, originally it was supposed to pay interest on required reserves, which we've discussed was actually very tiny. What happened, the theory was, as Ollie said, if you pay interest on bank reserves, that would set a floor in the interest rate. But it turned out it didn't set a floor in the interest rate because there was a handful of institutions that don't earn interest on reserves. Freddie Mac, Fannie Mae, the home loan banks, they are not allowed to earn interest on reserves. So they would have federal funds that earned nothing. So they would trade, federal funds are nothing but reserves held at the Fed. So they would want to trade their reserves to somebody who could earn federal funds and try to get paid the IEOR through a federal funds transaction. But a federal funds transaction is an unsecured transaction. I borrow federal funds for you, but there's no collateral. So nobody's going to lend a huge chunk of federal funds to little tiny small banks. They're not competitive. The only people that have a chance to get big federal funds from Fannie, Freddie, home loan banks are the really big U.S. banks or the foreign banks that are also big, because you got to be very big and trustworthy because it's an unsecured loan. Well, once the deposit insurance rules changed, the vigor shifted towards the European banks who don't have to pay deposit insurance premiums. But the people that can compete, so it becomes a very small market. There's a very few people that have federal funds to trade, and there's a very few set of banks that are going to bid for those federal funds and then stick them in Fed reserves and own the IEOR. So it becomes a very monopolistic market, and it doesn't settle very well. So the Fed finds out that a federal funds trading rate is way below the IEOR when they start out, and they're really upset about this because the Fed funds is their target. So since this market's not working very well, it says we're going to come along and we're going to allow money market mutual funds to enter the fray a little bit. We're going to create these things called overnight reverse repurchase agreements, which is the ONORR, which is what Jamie's talking about as the Fed's narrow bank. But it's not really a narrow bank. What it is a fairly complicated transaction where a money market mutual fund comes to the Fed and says, I'll be willing to willing to give you my money if you lend me your securities in a secured transaction overnight and you buy them back tomorrow. So here's the Fed that's a perfectly trustworthy counterparty who's making a collateralized loan to a money market mutual fund in order to get money out of the money market mutual funds and pay them an interest rate. So this is functionally about as elegant and as expensive as sweep accounts were under the required reserve ratio. So what Jamie's doing is he's eliminating that step and that expense of having to go through this trade, passing securities back and forth and giving money markets a way to earn. Moreover, the Fed set the overnight RP rate always below the OER, so they were never going to pay money market mutual funds the same. So the idea is that would be a floor under the floor, and the federal funds rate would trade somewhere in between. So we created this sort of Rube Goldberg device of all these monetary policy operations because the federal funds rate didn't actually behave the way the Fed thought it would when it first started paying interest on reserves and then doubled down by doing QE operations, trillions of dollars with them. So the monetary policy operation framework got really pushed into relying on this interest on excess reserves. Now, back to my point about the subsidy, which firms like Jamie would tend to compete away. If a money market mutual fund can get the same risk return profile at the same cost as Jamie's bank can give them, they're not going to bother depositing with Jamie's bank, probably. So at some level, there's got to be some benefit in there that the Fed is offering for this business plan, in my view, to work, and Jamie can talk about that. So my question is, aren't you really, at one level, isn't the narrow bank trying to fix the same problems that paying interest on required reserves really was originally intended to fix? Aren't you trying to get rid of all these operational things that are expensive and complicated that make this what you call the Fed's narrow bank work?
Right. I agree with a lot of your characterization. No, that's good. Let me just focus a minute on the Fed's ONRP. And like Paul, I'd like to point out that it is not in the interest of taxpayers to have the Federal Reserve running this ONRP. Why not? Because the Fed is not allowed to offer accounts to non-banks. That's the whole point of the Fed. The Fed's supposed to be a bank to banks, not to money market mutual funds. But they face this problem. How are we going to get the interest rate up when banks are so imperfectly competitive that they're not competing up the market rates? And they said, we're going to have to go into business against banks, and we'll have to create a facility so that money market funds effectively can deposit at the Fed. Now, the ONRP gives each participant a $30 billion cap. So money market mutual funds can invest overnight at the Fed up to $30 billion. As Paul explained, this is at an interest rate that's less than they pay banks. and they have to go through this reverse repurchase action in order to classify it as an open market operation. The Fed does have the legal ability to do open market operations with money market mutual funds. So they said we have to do an open market operation. So we have to give them a security. So here we are, the federal government, giving a private sector entity a security in addition to having the credit risk of the federal government. This is putting taxpayers' interest subordinate to the money market mutual fund. In addition, of course, the Fed doesn't have accounts for money market mutual funds, so they have to route these transactions through J.P. Morgan Chase and Bank of New York Mellon and pay millions of dollars a year for the privilege. So the taxpayers are not well served by the organization of this overnight reverse repurchase agreement facility, which is a narrow bank that is legally structured in order to comply with the Fed's limits of its actions. Now, I take some, again, a couple other points that Paul raised. Payment of interest on reserve, excess and required reserves. That was always contemplated. Again, Governor Meyer in 1999 said the board strongly supports proposals to allow payment of interest on demand deposits and on the required and excess reserve balances. So it was always foreseen that the Fed needed the ability to pay interest on excess reserve balances. I think that's an important aspect of getting rid of the reserve tax. It's a long story. I won't get into it, but it's really important. If we think about the old-style monetary policy implementation, that was terrible in terms of being fine-tuning. Every day, the Fed had to go in and try to forecast these autonomous factors, the Treasury account, the foreign repo pool, cash, and then they would, add or subtract some repos with these primary dealers, and they'd have to go through this small set of primary dealer firms, and then hope that money market rates that they got it right and money market rates would comply. That's a lousy way. Now the Fed has a much simpler way of simply paying interest to all the banks in the nation, and that is supposed to guide market interest rates. The sad thing is that banks aren't competitive enough by themselves to have that as a strong guide to rates. So we need something like a narrow bank. The Fed created a narrow bank because they realized they needed it, or a narrow bank sector to assist in this simpler and much less resource costly way of guiding interest rates. And so I think that's an important thing. The other thing is that I would go back to what Morgan pointed out. The Fed is concerned about the broader market, not just the federal funds rate, but they wanted to make sure that the overnight bank funding rate and the repo rates moved in tandem with the Fed funds rate. That's why they had to create this narrow bank of their own, because the money market mutual funds participate in these rates, and that was the sector that helped integrate the money markets.
Okay. Why don't we take a couple minutes each of the panelists, then we're going to move to the audience. Bob?
Yeah, I'd like to raise two issues and a question. If the Fed were to revert back to a balance sheet like it had before the financial crisis, a lot of these issues would go away because the amount of reserves potentially that would be in this market would essentially not be there. And does that then raise a question that goes back to your point? Number one, they could deal with the problem of having to forecast simply by being able to continuously buy and sell Fed funds throughout the day. Secondly, if they opened up the desk to all banks rather than dealing through the primary dealers. The primary dealers failed in the intermediation process during the financial crisis because of their vulnerabilities. And so opening things up might be another way of dealing with this problem. But the key here is the size of the Fed's balance sheet. If it keeps the size that it has, then a lot of these issues still are on the floor. If it doesn't, if it goes back, then the crowding out issue may potentially come up. And of course, The last point is that the Fed doesn't have to pay the same rate on excess reserves that it does on required reserves. That it just happens to be paying the same rate right now. So it could differentiate if it needed to.
Ollie?
My observation would be, look, there are a lot of ways to conduct monetary policy again. It's a whole lot easier to pull on a rope than to push a rope. And they're trying to push a rope. You can constrain economic activity by raising rates because you can make activity too expensive for people to engage in, and you can pull the economy back. Stimulating the economy is a lot more difficult process. And that's what they're talking about. They're trying to push on the rope. And that's what QE was all about and so on. And once we get back, they're trying to remove accommodation now. Once we get back to neutral, if they can settle down and start to look at monetary policy in more conventional terms, a lot of this issue may become less significant. I still think that, from my standpoint, the key issue is if the Fed is going to create an interest rate and is going to pay an interest rate to authorized institutions as described in the law, it's got to pay the interest rate to authorized institutions as described in the law.
Just briefly, so one of the lessons of all of this is just our institutional environment for monetary policy is extremely complicated, and I happen to think it's needlessly complicated. One of the great virtues of the narrow bank is its simplicity and transparency. I happen to have sort of a soft spot for the old scarce reserves way of doing interest rate policy. I think the problems of doing monetary policy by writing checks to banks is more than an optics problem. It's a distributional problem and an efficacy problem. On the reserve tax, the reserve tax has come up a lot. We have to keep in mind that only applies to required reserves, right? And there's this irony, the Fed says the purpose of interest on excess reserves and required reserves are two completely different things. One is to offset the supposed reserve tax, and the other is to give effect to monetary policy. And yet they are always set at exactly the same rate, even though they have two completely different justifications. And it's circular reasoning, right? What the Fed says is, well, we have to pay them the opportunity cost of what they would have earned had they not had reserve requirements. But in the absence of reserve requirements, all reserves would be excess, and so they would have received the rate. So it's just they put themselves in this perfect legal circle or perfect conceptual circle that doesn't make a lot of sense. I think we have to think of. I have questions about this whole idea of a reserve tax. I mean, a bank charter comes with a set of privileges and comes with a set of obligations, and we should be thinking of those as a package deal. And to single one of them out and say, oh, the failure to pay interest on required reserves is itself a tax for which we need to compensate banks, I think is just conceptually wrong, and I've always thought that. And my last point would just be this question of competing with banks and the Fed competition with banks. I mean, keep in mind, when we created the Fed, before the Fed, physical currency was issued by the banking system. Fed gets in the game of issuing physical currency. That was competing with the banking system. This isn't an unprecedented thing, and we need to think from first principles about the way our monetary system is constructed and not rule out any particular action just because it might present some competition to the banking system.
Yeah,
Okay, we're gonna go to the.
I'd like to go back to one thing. The reserve tax was gone for practical purposes before we got to interest on reserves.
Can I just address
What?
this, George?
Yes, it was effectively gone. Any significant bank met their reserves with
Right,
bulk
bulk
cash.
cash.
Bulk cash, it was.
Yeah.
It was gone.
I think that I just want to address this issue of reserve tax a little bit before we go to the audience, because the reason that there were no reserves in the banking system when the crisis hit is, as Ollie points out, banks had minimized their reserve requirements, and that is evidence of this costly. The problem with reserve tax is not that banks shouldn't be taxed and things like that. Go ahead and tax banks however you want, but the reserve tax is a particularly inopportune tax because it taxes the liquidity held by banks. And banks work to minimize that, as we would expect them to do in the face of a tax. And that was disadvantageous to the whole society. So the problem with the reserve tax is it causes banks to operate with no liquidity. But banks should have liquidity to meet unanticipated deposit withdrawals. So that's why we need.
We have a lot of liquidity.
That's
today.
why we need
So George, please.
interest on reserves.
A question, quick.
Thank you. Thank you. George Selgin from the Cato's Center for Monetary and Financial Alternatives. Both Jamie McAndrews and Morgan Ricks, both of you particularly argued that interest on excess reserves doesn't necessarily involve any subsidies. It's just a question of allowing it to be paid to a larger number of institutions. At least this was my understanding. But I'd like to take issue with that. If interest on excess reserves, as it has been paid so far, doesn't include any implicit subsidies, we should ask, why can't, say, money market funds earn the same return themselves? What is it that the Fed is able to do to earn a better return than they can on their own? And it seems to me that there are two reasons, but correct me if I'm wrong. One is that the Fed, unlike money market funds, can have long-term assets in its portfolio. But the reason it can make higher interest payments that way is because it doesn't have to worry about interest rate or duration risk associated with having such assets, or to provide loan loss reserves to cover itself from these risks. Instead, the Treasury bears the risk, which means taxpayers do, in the form of potential reductions in future Fed remittances. So this is one way, it seems to me, that there is a subsidy involved, or can be. The other is that as a monopoly supplier of the nation's currency, which is non-interest bearing, of course, the Fed earns substantial seigniorage revenues, and it is capable of using those monopoly rents to cross-subsidize reserves. That is, conceivably, it can pay an interest rate on reserves that's higher than the return on the assets that those reserves fund, and there again you have a possible subsidy. So if the Fed is taking advantage of either of these devices, doesn't that in fact mean that interest on reserves involves a subsidy? And if so, then the question I have is, first of all, do you think that that is indeed a possibility? And second, is it obvious, if that's true, that extending the subsidy to a larger set of institutions is improving things rather than making them worse? Those are my questions.
Thanks, George. Who wants to take that?
Well, thank you. I think that you raise issues about the fundamental economics of central banking, which I really don't want to get into. My view is the following, that if the Federal Reserve pays interest on reserves to banks and that interest is passed on to depositors, then the bank will not be able to book any profits on its reserve revenue from the Fed. And that's the aim that the narrow bank is pushing toward.
Okay, let's go, not you yet, Bert, right behind there, and then after that, then Bert. A quick question, please. State who you are and your affiliation. And
yes, I'm with the IMF. I'm Manmohan Singh. Done some work on plumbing. It's a question both for Jamie or Morgan. I still believe we are pushing on the string. So if indeed this carries on, the narrow bank, and it's replicated, it's a homogeneous product, and market really comes to a very small range, do you see the fact that money bypasses the plumbing? It goes straight to the Fed, one way or the other. So the ratio of money in the market relative to collateral, which is needed to price repos, sec lending, prime brokerage, there's a plethora of plumbing which is a nexus of money and collateral. But if money bypasses it in large numbers, assuming the TNB model is successful, the market rates will rise. The market rates will be different because the ratio of money collateral changes. Do you have a view on that?
Yes, the Federal Reserve has, as I mentioned, has two narrow banks, the ONRRP and the foreign repo pool, which together were about $750 billion, $750 billion at their maximum combined. And that, I don't think that had any ill effects on the market. As Simon Potter mentioned, there were very little in terms of observable effects on flows in the different markets. Again, what the narrow banks and what reserves do is for the consolidated balance sheet of the government, the Treasury plus the Federal Reserve, it is a translation of different government liabilities. So it doesn't bypass anything, or it doesn't subsume any other activity. It's just how the public wants to hold their government liabilities.
To Jamie's point, even more, essentially, on a consolidated basis, which is really the way to look at it, the Fed is taking Treasury securities with maturities and MBS out of the market and putting in a demand liability into the process. So that's a maturity transformation in some sense that goes on. And people have been worried about what the impact on the market would be as the Fed balance sheet is shrunk. But what they forget is that over the time the Fed's balance sheet is now declined by about $240 billion, the Treasury has issued more than $1 trillion of new debt in excess of what it was at the time it started, the Fed started the process. So it's really Treasury issuance that determines what the term structure is looking like, a lot more than what the Fed is doing when it comes to its asset shrinkage.
But, okay, so I think back to the collateral issue through the overnight reverse repo facility, the Fed essentially can recycle its Treasury portfolio and lend it out to the market, so the collateral is actually there for other firms to rehypothecate.
Those assets are not rehypothecated. This is simply subsuming the taxpayer's interest to these money market mutual funds. The proffering of collateral in that facility is simply to make it a legal facility as an open market operation. It has no economic significance other than subsuming taxpayer interest in favor of the money market mutual funds.
Bert.
Thank you. Bert Ely, banking consultant. A question for Jamie. If I heard you correctly, you said that if TNB got its Fed account, that there could be other narrow banks that get chartered. Am I correct on that?
Well, what I said is I could imagine that copycats would come in and attempt to compete with us if we were allowed what is a clear mandate, which is getting an account at the Fed.
Well, thank you. Thank you for that clarification, because it raises this question that if other entities could form comparable narrow banks, why wouldn't the large bank holding companies seek a charter for their own narrow bank? And if that were to occur, Morgan had one, Goldman Sachs had one, and Morgan Stanley and the others each had their own narrow bank that they owned. How would the narrow bank be able to compete against the narrow bank subsidiaries of the large holding companies?
That's a very good question, Bert. I'm not going to fully address it here. The narrow bank has to have a specific form, so we can talk after the conference. But this is very similar to my recommendation of segregated balance accounts, which I had recommended while I was at the Federal Reserve, that every bank could have a narrow bank, and that is something that also the Federal Reserve could decide to do. They said they put that potential policy on the shelf, but they could alternatively, rather than running their own narrow bank, they could allow every bank in the nation to run a narrow bank if they want. But we believe that the narrow bank is very efficiently organized, has a great credibility, and would be able to compete with all comers. Thanks.
Bonnie Wachtel, I'm in the investment business. I'm struck by the central position of money market mutual funds in this discussion. And I know one of the sets of slides had a bullet point where it said the reverse repo would go away under this proposal, so the money market funds would have to find other alternatives. Could whoever wrote that elaborate a bit on what alternatives do you think they would find? What would they be doing with the money market mutual fund?
Let me just say that the narrow bank would not impact money market funds in any way, shape, or form. Money market funds would not go away. The narrow bank is simply a bank. They were starting a bank. Money market funds won't disappear or anything like that. So, you know.
The same level of interest?
I'm sorry?
Same level of interest as they experience today?
Money market mutual funds? Yeah. Money market mutual funds today have the public option, the Fed's narrow bank. Presumably that would continue along. And we would not displace the Fed's narrow bank. We would compete with it. But, you know, we have no control over what the Fed offers or anything else. We're just a bank. You know, we're trying to get into business, and we would offer our products to money market mutual funds and other corporations and other potential large investors.
I thought your question related to the relationship between money funds, money market funds, and the repo market. That's the part that would just probably disappear because it would be more efficient for them to go through the narrow bank.
I don't know that these things would disappear. There are people who hold Treasury securities who want to finance them.
Oh, but I mean
and
the
they
Fed's,
would go to the repo market.
But the Fed's reverse
we
repo.
wouldn't.
The Fed's reverse.
Oh, the Fed's reverse repo. We may offer a better, more favorable interest rate. Who knows? The Fed could compete with us.
Let me quickly clarify, and I think George had a comment. I don't know how many other people in this room have clients who own money market mutual funds or own them themselves, but I can tell you the interest rate being offered is quite generous compared to what's available at banks, exactly as you all have discussed in your talk. So the question really is, would you foresee difficulties in money market mutual funds being able to participate at such a close relationship to the Fed funds rate as they do now?
We would improve. Right. We believe we would offer improvements to money market mutual funds. Absolutely.
I'll offer a small caveat there. So a year back or so, I wrote a piece where I said, you know, money market mutual funds ought to have the option of depositing at the Fed and have an account at the Fed and earn the IEOR. And I went over to talk to the Investment Company Institute. Paul Schatz-Stevens, the president, and he says, well, in principle, that's a great idea, but none of our funds would want anything to do with it. You would never, if you have an account at the Fed, then the Fed wants to regulate everything you do, and the industry would want to stay light years away from any kind of arrangement like that. But enter TNB and Jamie McAndrews and his bank, who will stand in and deal with all the regulatory headaches of dealing with the Fed, but give the mutual funds the ability to put deposits in TNB, and for that small service cost or whatever, avoid the hassles of becoming part of the Federal Reserve regulatory empire.
I'd like to answer one question, if we have a moment, that Bob raised, which is, you know, he was raising the question whether we could revert back to the system where no interest was paid on reserves, and you mentioned that as well in your preamble. I'd like to refer you to a May 2017 speech by Lori Logan, the Deputy SOMA Manager. Wonderful speech that is I think, a really great primer on how monetary policy is implemented today. And she focuses a lot on these liabilities of the Fed, which she calls electronic non-reserve liabilities. So it's that part of the balance sheet that is not cash, that's not reserves. These are liabilities held by designated financial market utilities, roughly 60 or 70 billion, foreign central banks, 260 billion, the Treasury, which varies from 0 to 700 billion, and the ONRP, which has been small recently but was up as high as 400 billion. She points out that all of these liabilities are volatile, and to cut back on these liabilities would be in disfavor to each of those constituencies, designated financial market utilities, foreign central banks, the U.S. Treasury, and the money market mutual funds and so on that participate in the ONRP. So it's going to be hard to cut those back. And if one doesn't cut them back significantly, the variability in the size of those liabilities greatly exceeds the desk's ability to adjust monetary policy on the day. And so that's a big concern. And so in another speech more recently, Lori also pointed out that it's simply going to be a very big lift to try to reduce the size of the Federal Reserve balance sheet. And again, the key issue, and there was a watershed in U.S. financial history when interest on reserve was allowed, because then the demand for reserves and these non-reserve electronic liabilities of the Fed expanded, and they are shock absorbers, and they more easily transmit interest rates and allow adjustments to financial market developments, such as the change in the money market mutual fund regulations in 2016 and so on. So these are all benefits we have from interest on reserves. It's sort of like, why don't we go back to the horse and buggy days after we've gotten the internal combustion engine? It's feasible to think about that, but it's unclear why anyone would voluntarily choose to do that.
George?
Yeah, Jamie, is that on? You keep identifying interest on reserves with the present floor system, but they're two different things. Before 2008, before the Emergency Stabilization Act, the intent of it was to pay interest on reserves, but not to have a floor system. So they don't go hand in hand. Most countries in the world today use corridor arrangements with interest on reserves. They just don't have the policy rate equal to the interest on reserve rate. So I think that, correct me if I'm wrong, but aren't you confusing occasionally the benefits of interest on reserves and the need or the advantages of such with those of having a floor system, which is the specific way we're using interest on reserves since 2008?
Thanks for the question. I would agree with you without the word confusion. I'm sometimes confounding those two. I take that point. However, it was always contemplated that in the testimony by Governors Meyer, Ferguson, and Olson, that interest be paid on both required and excess reserves. So that was always because they all explained that the Federal Reserve would need the flexibility to pay interest on excess reserves. Now, there are different ways to implement this, I agree, and we see a different way today, and we see a very novel way. This is absolutely unique that the Federal Reserve comes in and creates a narrow bank. And that's the primary way that that monetary policy is being implemented through this narrow bank over the last several years. It's not so much in evidence right now, but because of market conditions. But so paying interest to banks and paying interest to these money market mutual funds separately has been an important, I believe, an important advance in the way monetary policy is implemented. I do think that there are other ways monetary policy could be implemented that would confer on society many of the benefits that we see with the current system, but that's a long discussion. But
we have 1 minute and we have 2 minutes left. So, Bert, you have 2 minutes to get your question in and get an answer, which is very tough for you.
Thank you. Jamie, to what extent have you done any modeling of what your narrow bank would do to the balance sheets and earnings and ROEs of the large banks in the country that now hold so much in the way of the excess reserves?
No, it's very uncertain that we would have any effect. Again, as Simon Potter pointed out, the Federal Reserve's narrow bank had very few measurable effects in secured and unsecured market quantities. It just caused rate competition, and we think that would be the primary effect of the narrow bank, that we would increase deposit rates for large depositors. It's not necessarily clear, because they would also be able to, in some cases they've been looking to shed some of these non-operational deposits and so on. There may be a win-win situation there as well. So it's not clear exactly what the effects would be, other than deposit rates would rise for large depositors.
So with that, if you leave your name and address, I'll contact the large banks, and if they want to get rid of their excess deposits, I'll forward your names. But can we thank our panel? It's a very interesting discussion.
Thank you. Thank you.